Hey, everybody, welcome to the morning market briefing. It's Tuesday, May 2nd, 2023. Hope you're doing well out there. Full call today. Tom, how's it going, man?
Oh, it's Tuesday. We're making our way through the week.
We're getting there one day at a time. We're going to open up with ISM Manufacturing. We saw some stabilization, slightly higher reading than expected, came in at 47.1. That was higher than the last reading of 46.3, higher than the expectation of 46.8. But as a reminder, anything under 50 does technically still show a contracting portion of the economy. Interesting commentary, kind of all over the place in a lot of regards. What stood out to you?
I think the big thing is that it's stabilized. We looked at the charts, the divergence between manufacturing and services during our macro call. We've talked about it a lot on here, but the fact that, it basically has been declining significantly since COVID, but we've seemed to hit a plateau is probably good for the overall economy. I mean, we want things to be slowing, but we don't want them to just be in constant free fall. We saw a little bit of that data when we got GDP. There were some surprises there on the manufacturing side. And so I think this reads through as that being more accurate maybe than we thought. I think it's interesting though, because the retail side really was struggling towards the middle of last year. We talked about the idea of potentially rolling recessions, different areas of the market, taking turns of who's in the barrel. And perhaps this is maybe a sign that we're starting to see a little bit of a recovery on the sales side, because a lot of this is related to building inventories, making sure you're ready for, back to school, patio furniture, all those things come by way of the manufacturing system. And so it looks like we've got a little bit more stability there than we've had over the last, call it a year or so.
Yeah, some interesting quotes from those surveyed. One electrical equipment company says sales continue to be soft, similar to 2019 pre-COVID. They expect softness to last for as long as another 2 years. Kind of interesting to think about almost this resetting to pre-COVID times in terms of economic growth. Someone else said business conditions remain strong. Sales and bookings are exceeding the plan. So a bit of a contradiction there, perhaps. Someone else in the plastic and rubbers products saying business is picking up. And then someone notably in the metal space, we seem to be in a season of contradictions. Business is slowing, but in some ways it isn't. Prices for some commodities are stabilizing, but not for others. Some product shortages are over, others aren't. Trucking is more plentiful, except when it isn't. So kind of this maybe a potential read through lending credence to kind of the theory that we're just in this prolonged rolling recession of sorts, where certain pockets are seeing real challenges while others are continuing to press on. We did see prices up to 53.2. Last reading was 49.2. This is the highest level since July, probably specifically related to some of the OPEC plus oil cuts, the most likely cause there. Employment came in at 50.2, best number we've seen since July. So the second straight month labor management sentiment for these companies was at essentially parity. Turnover rates declined in April, recording the lowest levels since the measurement began in mid-2021. New orders, a little bit of an uptick to 45.7 from 44.3. But again, it's not a number that's going to knock your socks off. So interesting data there. We will get the JOLTS report later today. So something to keep an eye on in terms of the jobs opening. Though I have to say, I don't know if you would agree with this, Tom. I just don't care about the JOLTS report anymore. It just seems ridiculous.
It's really out of whack. I think the Fed looks at it probably more than they should. But we want to see a decline in that number. If we see a decline in that number, the potential for inflation to be coming down faster than the Fed is anticipating is there. I think dovetailing that with ISM, right now we essentially have this thesis that the market is slowing much faster than the Fed is thinking, that inflation is eroding much faster than the Fed is thinking. We've had some contradictory data points over the last couple of weeks, but I think that if we see a larger fall than anticipated in the JOLTS, the job openings, and if we see a larger fall in ISM services than is anticipated, then I think that lends some credence to the fact that inflation is probably coming down. Though this price stability that we're seeing on the manufacturing side is definitely going to be a headwind to that thesis as well.
Yeah, definitely something to keep an eye on. Meanwhile, the FDIC weighing new programs. Not necessarily surprising to see that they're thinking through new things. They're looking to improve the FDIC through one of three options. And the best option they've decided is probably number one. How do you kind of take into account all of the things they're juggling, and where do you think they're going?
I think they've realized that a lot of the rules on the books are pretty antiquated. $250,000 as the insured amount is not a lot of money, especially when you start dealing with businesses, which is really the impetus for the Silicon Valley Bank problem. On top of that, I think they're getting a ton of pressure, probably from the top down, saying, "Hey, we can't have any more banks fail. This is a bad look for everybody." What are some new rules, some new guidelines we can put in place that perhaps could improve liquidity without really changing the system too much? And I think raising the cap is going to be very important. Whether or not they decide to make it unlimited, whether they decide to raise it from 250,000 to $1 million to cut down on the number of banks you need to be facilitating through. There are a lot of changes that probably need to be made, and I think that everyone's been caught with their pants down a little bit on this whole situation, and they want to make it so what they're doing is not necessarily illegal, which we've covered a bunch on this call. Yeah. The moves that were made in a lot of ways have not been according to the laws in place, and they probably want to go back and retroactively change those laws and make it look a little less questionable in terms of the actions taken over the last couple of months.
Yeah, when you think about it, it's like option one is probably where they're headed, which is they're going to raise the deposit insurance protection on accounts, specifically those tied to payroll and business execution, business payments. The other option is just make it unlimited. That seems far-fetched, and that's going to be really hard to get that done structurally, legally, all of that stuff. Third option is generally raising the $250,000 cap. I think it makes sense to prioritize business accounts. The challenge I think they're going to face is the significant number of accounts that are going to be impacted there. At some point, you're not deviating that far from the existing cap raise theory of just raising everybody.
Yeah.
I don't know. I think of even just our company, it's, we're 3 or 4 runs of payroll and we could hit the FDIC limit of cash. So if we want to have 2 months of pay sitting in a bank account, we're over that. And we're a small company. You think of large companies that are running payroll, maybe even every Friday. If they have that cash raised and available in cash form on Thursday and the bank goes under, that's a big problem. So they're going to have to address some of that stuff, but it just seems like it's going to be a bit of a paperwork and clerical nightmare to kind of establish that. Because even, again, think of our company, we have multiple bank accounts.
Yeah.
How are we going to determine which one should have a higher limit?
Yeah. The question is, are they going to have to institute a new type of bank account? Like, this is a business and payroll checking account, and you can only use it for that.
Yep.
And those are the only, and there's going to be, it's kind of like back in the day. I don't even know if they still do this because I haven't been inside of a bank or really thought about banking, but used to be, you wouldn't have to pay fees on your savings account if you had a direct deposit in it.
Yep.
But if you didn't, you did. And so, I'm sure there's going to be some sort of,
it's going to have an adverse reaction, I think, to the businesses that have those accounts.
Yeah.
There's got to be a trade-off. I think in our industry specifically of, some of the ADR that trade very thinly. A couple of years ago, FINRA, the regulating body for brokers, dealers, came in and said, hey, if you're trading these things, we're going to require a whole lot more compliance. And the brokerage firms basically said, okay, there's nothing we can do about this. We will comply. But what we can do is we can charge a really large commission for trading these securities to our customers to cover our cost of compliance. And ultimately, the loser of that is not the brokers and dealers, it's the actual customer.
Yep.
I think you're going to see something similar where, hey, you can have one of these super premium, high limit FDIC insured accounts, but you're going to get nothing for it and you'll like it.
Yeah, you're going to get zero interest, you're going to pay high fees, and we're going to ding you if you're not using it for payroll.
Yep. Fed meeting tomorrow. We've heard from Nick Timmerhouse. What are we looking at? What are you thinking? What are you feeling?
I think it's a foregone conclusion that they raised 25 basis points. The probability is sitting right at 1 right now. So I think that happens. If it doesn't, I think the market's absolutely ramp, but I just don't think that's in the Fed's wheelhouse to change course at this point. I think they've signaled well enough that we're going to get at least one more. In terms of guidance, I'm thinking it's going to be a little bit more balanced going forward. There's a possibility they raise again. I'm leaning that way, but they haven't really indicated one way or another. And I think we get 0 to that effect this afternoon. And quote, they said, until now, officials have been looking for clear signs of a slowdown, easing inflation to justify an end of rate increases, which I'm assuming is coming straight from the Fed to Nick Timmerhouse saying that they're hoping for something. They're looking for some reason to stop this. Until they see it, they're probably going to continue to raise rates. The problem is they're always backward looking. There are already some signs that the economy is slowing significantly. And they're not going to be looking at that data perhaps until after their next meeting. So, I think the slow march upward continues. I think it continues probably until June. And then at that point, I think we're probably going to stay put. There was a woman on yesterday. She's a big bond fund manager. I forget her first name, but she was working for TWC, which is a company that has some very, very large bond funds. And her base case expectation is that they're going to continue raising at least twice more, and that they're not going to cut until next year, maybe even towards the end of the first quarter of next year. And I tend to lean that way as well. I think that the cuts that are being priced in are a little premature, and that people are going to get caught off sides on that. So
yeah, I tend to agree as well. I mean, I just think they're going to remain a little more stubborn than maybe the market anticipates.
Yeah.
And I don't know that that's wrong for what it's worth. I mean, it seems like it would be awfully premature at this point to call it pause. In light of that, in light of how far we've moved over the last 12 to 15 months, it does not seem like 2 hikes is unprecedented, unexpected, or unlikely.
Yeah.
And I think we're all kind of fooling ourselves if we have a variant view on that.
Yeah. I mean, you got to protect the downside. The downside is they're going to raise rates. The upside would be awesome. I'd love it if they didn't raise rates tomorrow. The market would absolutely rocket. Bonds would rocket. Everything would look amazing. But the problem is that's probably a very unlikely scenario. And so you need to prepare for the opposite of that.
We did get a report from the Fed on the SVB collapse. Michael Barr, the Fed's vice chair for supervision, noted that they didn't fully appreciate the extent of the vulnerabilities of Silicon Valley Bank. Supervisors essentially identified the risk, said, hey, here's some problems, but they didn't do anything about it. Moving forward, he's calling for a revamping of rules that apply to banks with more than $100 billion in assets, called to reevaluate how regulators treat deposits over 250,000. Jay Powell said he would back steps that would toughen industry oversight in the coming years. All of these things make sense. All of these things are also in hindsight. When something goes poorly, it's relatively easy to say, okay, well, here's what we didn't do right. I think it'll be interesting to see what they can come up with if they overstep. A couple takeaways from the collapse: SVB management and board failed to manage their risks. Yeah, you think? Managerial weaknesses, highly concentrated business model, a reliance on uninsured deposits. All of these things are things that could have been known prior to the collapse. Supervisors didn't fully appreciate the extent of their vulnerabilities. Essentially the same thing. When supervisors did identify vulnerabilities, they didn't take enough steps to fix it. And then the board's response to the 2019 rule change and a shift in the stance of supervisory policy impeded the effectiveness of supervision. So basically, they got some relief on rules in 2019, and they leaned into those rather than saying, hey, how do we keep ourselves accountable? So kind of interesting. I don't know if there was really anything that we learned from that report.
Yeah, there was. What's surprising to me is that there's been 0 pressure on Mary Daly, who's the head of the San Francisco Fed. I mean, 100% of the banks that have went under on her watch, and she seems to be pretty Teflon here. There's been no touching of her in terms of responsibility. She's ultimately where the buck stops in terms of that entire region. And there's nothing there. I mean, it's interesting that they obviously accepted responsibility. They didn't pay any attention to the risk being taken, but I mean, it's pretty easy stuff. Everything that happened was completely avoidable.
Yep.
With just basic portfolio management. The question is, who they put in charge and why. There's a lot. I mean, even Muhammad Al-Arian in his op-ed talked about the over influence of the DEI, the diversity, equity, and inclusion stuff that, who is in charge may not have been the most meritorious candidates. And so, that's a little bit of a question mark in terms of how the San Francisco Fed runs its supervisory board.
Which lends itself to the Fed at large, Fed vice chairman search. What are we seeing?
So it seems that the push for more diversity on the Fed is in full effect. Obviously, Lyle Brainerd has left as the vice chair and moved in the Biden administration, and she was really considered the one that was going to take on the next. She was going to be the next Jay Powell. She was going to be, another female Fed chair. But it looks like the nominee is going to be a guy named Philip Jefferson, who's a member of the Fed. He was previously, I believe, the head of economics at Davidson College. He's definitely got a lot of support. When he was nominated, he didn't have any problem getting through. So that's probably the next guy. I'm surprised it's not Raphael Bostic, who's the head of the Atlanta Fed. But I mean, Philip Jefferson's a pretty middle of the road guy. I'm pretty comfortable with him being vice chair. And then on top of that, to replace another, we've got Adriana Kugler, who I believe we've talked about before as a potential candidate. But she's really more of a labor regulations, immigration, unemployment. So she's going to sort of check that ESG box in terms of adding someone to the board that has a little bit more of an ESG flavor, as that's something that's being sort of pushed towards the Fed. The ECB's already adopted those, those sort of stances, but we'll see, if that has a net effect going forward on the Fed, whether or not they're going to try and add a third mandate, which would be, climate change, ESG, those kinds of things. But she would probably be the person to do it.
Kugler notably has a PhD from Cal Berkeley. Her dissertation advisor was Janet Yellen's husband. So,
Nepo baby.
Yeah. Not that means anything in the world of central banking.
Yeah. The number of people who can be Fed people is a very small,
very
pool,
narrow,
and they're all very closely related.
And they all love each other.
Yeah. So not a surprise there.
Yeah. Cool. We'll wrap it up there. Futures right now down just a little bit. Dow futures down 22 basis points. NASDAQ down 8. Oil down about 1/3%. Gold ticking up just a little bit here. So we'll keep an eye on the day, and we will be back tomorrow morning at 8:30. Have a great day.